Good afternoon, and welcome to the NCUA's Liquidity Risk Management webinar. I'm Christelle Oriusetti, a policy officer in the Office of Examination and Insurance. Today, we'll dive into liquidity risk management and discuss the areas of focus highlighted in the agency's advisory on liquidity risk management issued in January. But before we begin, I will cover some technical tips to make sure that you can see the webinar console and hear the presenters. First, all attendees will be in listen-only mode. Second, if you have questions, you can submit them anytime using the Q&A button at the bottom right corner of your WebEx console. To submit a question, simply click the Q&A button. Type your question into the box provided and then click send. We will do our very best to answer your questions as time allows. Third, if your volume's too low, check to make sure your volume is turned up on your computer. You may have to plug in external speakers if that doesn't work. Fourth, closed captions will be available within WebEx. To enable captions, click the CC icon in the bottom left of the console. I want to now welcome NCUA's Board Chairman, Todd Harper, who will start us off with some opening remarks. Chairman Harper, thank you for joining us.
And thank you, Christelle, and good afternoon, everyone. Thank you for joining today's webinar on liquidity risk management. We anticipate a large turnout today, and that speaks to the enormous importance of liquidity management in the evolving economic environment. The NCUA has seen growing signs of financial strain on credit union balance sheets in recent quarters, along with growing consumer financial stress. Liquidity risk is one of those financial strains. Therefore, we have scheduled this webinar to present liquidity management principles and provide scenarios to add to the learning experience. As we begin, I should thank NCUA's Director of the Office of Examination and Insurance, Kelly Lay, and her outstanding team for coordinating today's session. This team also drafted the NCUA's recent advisory on liquidity risk management, which will guide much of today's discussion. In this current environment of heightened interest rates and evolving economic conditions, liquidity management remains an area of focus for the NCUA. As such, credit union senior management and board directors must understand and manage liquidity needs to meet cash and collateral obligations at a reasonable cost and both expected and unexpected cash flow requirements. Moreover, when last year's regional bank failures occurred, they rippled across our nation's financial system, and those events served as a stark reminder for financial institutions of all types, including credit unions, to be vigilant in recognizing and mitigating several different factors, including the risk of a high level of uninsured shares and deposit balances, the financial risk of having depreciated asset valuations, and the rising costs of funding. To that end, NCUA examiners this year are assessing, one, how you're controlling the cost of funding as part of your net interest margin within your cash flow projections. Two, your access to wholesale funding providers, such as the Central Liquidity Facility of the NCUA or the Federal Reserve's discount window. And three, your overall liquidity risk management framework. The NCUA also recognizes that some credit unions are simultaneously experiencing slower share growth, higher loan growth, and declining levels of available liquidity. Under these conditions, credit union executives, administrators, and board directors must diligently manage the identified interest rate, credit, and liquidity risks within their institutions. Said more simply, today's marketplace requires active, not passive, management by everyone within a credit union. The importance of liquidity planning for financial institutions of all sizes cannot be overstated, especially after the closure of the Federal Reserve's Bank Term Funding Program last month. This temporary program stabilized the banking and financial system after last year's collapse of Silicon Valley, Signature, and First Republic banks. With the sunset of the Bank Term Funding Program, credit unions must ensure that they have lined up other ready sources of liquidity for availability should they need them. In fact, access to the NCUA's Central Liquidity Facility and the Federal Reserve's discount window should be part of participating credit unions' broader liquidity risk management plans for a variety of contingencies, not just during a time of crisis. Additionally, the NCUA board has repeatedly called on Congress to provide corporate credit unions with greater flexibility to purchase capital stock in the central liquidity facility to help smaller credit unions access liquidity. We will continue to engage with Congress on this legislative priority and consider other actions going forward to ensure sufficient liquidity at individual credit unions and within the credit union system as a whole. In closing, the NCUA fully understands the economic climate and the resulting risks that many of your credit unions must now navigate. The knowledge you gain today will assist you in preparing for those challenges ahead. Should you have any more additional questions or concerns after today's webinar, please contact your regional NCUA office or the NCUA's Office of Examination and Insurance. Thank you once again for joining today. With that, I'll now return the microphone over to Christelle.
Thank you so much, Chairman Harper. Before I cover the agenda, there is one more housekeeping item. The materials presented in this webinar are intended as an informative and educational summary of general information and updates regarding liquidity risk management. The NCUA has taken reasonable measures to ensure the quality of the data and other information produced by the NCUA that is available in this presentation. The NCUA, however, makes no warranty, express or implied, nor assumes any legal liability or responsibility for the accuracy, correctness, or completeness of any information that is available through this presentation, nor represents that its use would not infringe upon privately owned rights. The slides are intended for educational and discussion purposes and do not constitute legal advice nor replace independent professional judgment. Reference to any specific commercial product, process, or service by trade name, trademark, manufacturer, or otherwise does not constitute an endorsement, recommendation, or favoring by the U.S. government or the NCUA. Now to the agenda. Over the next 60 minutes, we'll delve into liquidity risk management. To help me today with the webinar, I have Dale Klein from the Office of Examination and Insurance's Division of Capital Markets. I also have Elliot Weiss from E&I's Policy Division. Dale will discuss market events leading to the NCUA's heightened liquidity concerns and the agency's response to these events, and liquidity risk management fundamentals and focus areas highlighted in January's advisory on liquidity risk management. We will leave time at the end of the presentation to answer your questions, so please make sure you add those there. Well, let's begin. First, Dale will cover recent market events and liquidity risk management.
Thank you, Christelle, and thanks for everyone for joining us for this credit union webinar. With this webinar, we are following up on the liquidity risk management advisory issued in January this year. Liquidity risk and credit union management of liquidity are heightened concerns for the agency. In this webinar, we will briefly recap events leading up to this point, discuss 5 areas of concern within liquidity risk management, and address your questions as time allows. About 2 years ago, the Federal Reserve started its rapid increase in interest rates to fight inflation. As inflation persisted, they continued to increase rates. Today, short-term rates are near 40-year highs. Additionally, the yield curve is inverted, as it has been for most of the last 18 months, making the future path of interest rates remain uncertain. Over a year ago, Silicon Valley Bank, Signature Bank, and First Republic Bank failed, shaking the financial system. Many were afraid these failures would lead to systemic problems and shake depositor confidence. The federal banking agencies acted quickly to resolve these bank failures. They took steps to relieve the pressure of contagion and help provide liquidity to credit unions and banks during this time of stress. One of the actions was the Federal Reserve's creation of the Bank Term Funding Program, or BTFP. Many credit unions used this liquidity facility. The Bank Term Funding Program stopped making new advances last month, yet existing loans are good to maturity or repayment as initially contracted. These and other systemic events, and perhaps some credit union-specific circumstances, have necessitated reflection on liquidity risk and liquidity risk management. In response to these events, the NCUA closely monitored credit union liquidity and communicated our concerns. In January 2023, the NCUA issued our annual advisory on supervisory priorities. Liquidity risk was a top concern, and its link to the interest rate environment was highlighted. In July 2023, the NCUA and other federal banking agencies updated liquidity risk management guidance through the Interagency Policy Statement on Funding and Liquidity Risk Management and the Importance of Contingency Funding Plans. In January 2024, the NCUA issued an advisory on liquidity risk management, and most recently, in February, the agency's 2024 supervisory priorities again highlighted liquidity risk as one of our primary concerns. Liquidity risks rarely occur in a vacuum. In fact, none of the CAMELS components exist in a vacuum. The most recent upturn in rates and their impact is following a predictable pattern. When rates rose, we saw the typical response from credit union members. They expected higher returns on their share and CD rates. Borrowing sources and non-member depositors also expected a greater return. This leads to not only increasing share costs, but to keep up, management needed to originate new loans at higher rates to compensate, creating another drag on liquidity just as it's needed the most. A lot of institutions will try to lag the market with their core deposits by using alternative funding like broker deposits and borrowings. These changes have a direct impact on liquidity, both on balance sheet and off, and that may impact earnings and capital. Because of this, it is imperative that credit union monitoring and reporting clearly communicate the impact potential and implications to interest rates spilling over. Last, I will emphasize that the NCUA's supervisory test rating is not something we expect credit unions to manage to. It is one of the supervisory tools used by examiners to rate credit union risk and CAMELS components. Now we will move into liquidity risk management. Despite all that has gone on in the last few years, the basics of liquidity risk management remain the same. Credit unions need strong corporate governance, clear and concise policies, resilient asset liability management, potent internal controls, and diversified funding sources. The recent events have heightened the importance of 5 key areas that the NCUA considers areas of concern. In January, the NCUA issued an advisory on liquidity risk management, which is provided as an appendix to this presentation. The advisory on liquidity risk management highlights 5 areas of concern: forecasting cash flows, controlling asset composition, structuring liabilities, governance and monitoring, and finally, diversified liquidity sources. We will begin by discussing cash flow forecasting. One lesson of the 2008-2009 financial crisis is that consumer behaviors and risk relationships change during stress. This is the same today. To explore a range of plausible and stressed cash flow outcomes under varying conditions, credit unions need to set clear objectives for their cash flow forecasts, conduct robust stress testing commensurate with their size, complexity, and risk profile, and challenge assumptions to explore potential unknown hazards during times of change. The first step in forecasting cash flows is establishing clear objectives. This involves defining the time horizon for the forecast, the level of detail required, critical metrics for monitoring and evaluating forecasts, and the uses for these results. For example, Clearly stated objectives may be: we will produce 5, 30, 60, and 90-day cash flow ranges under various assumptions and a business as usual scenario approved by the Chief Risk Officer to make short-term funding decisions. Clear objectives such as these help guide the forecasting process and ensure the forecasts meet the credit union's needs. Stress testing involves simulating various scenarios to assess the impact of adverse events on cash flows and liquidity. Stress test results should be compared to policy limits and risk thresholds. This helps identify potential vulnerabilities and allows the credit union to establish appropriate limits and contingency plans. By stress testing cash flows and limits, credit unions can enhance their ability to withstand unexpected shocks and maintain financial stability. A lesson reinforced by recent events is to challenge standard assumptions, especially during stress or marketplace change. Forecasting cash flows requires assumptions about future economic conditions, member behavior, and other factors that may impact cash flow. It is essential to rigorously challenge these assumptions and to ensure they are realistic and to explore potential vulnerabilities as member behaviors and risk relationships change. This may involve seeking input from multiple sources within the credit union, conducting sensitivity analysis, and considering historical data. Challenging assumptions helps enhance the view of potential outcomes and improves decision making. Forecasting credit union cash flows involves setting clear objectives, stress testing cash flows and limits, and challenging assumptions. By following these steps, credit unions can improve the accuracy and reliability of their cash flow forecasts, enhance their ability to manage liquidity risk, and make informed financial decisions. Controlling asset composition and credit union balance sheets is crucial for managing risk, ensuring liquidity, and achieving financial goals. This involves aligning credit policies with cash flow expectations, managing unfunded commitments, and monitoring asset quality. Liquidity risk management relies on prudent credit policies that consider the cash flow characteristics of their assets. For example, loans with regular, predictable cash flows, such as mortgages, may be more suitable for funding from long-term liabilities. In contrast, loans with irregular or uncertain cash flows, such as unsecured consumer loans, may require shorter-term liabilities or higher liquidity reserves to manage risk. By aligning credit policy with cash flow expectations, credit unions can optimize their asset composition to meet funding needs while managing risks. Secondly, understanding unfunded commitments is essential for understanding future cash flow needs. Credit unions need to often provide unfunded obligations, such as credit cards, lines of credit, or loan commitments, which can create contingent liabilities. Managing these commitments is essential to controlling asset composition and liquidity risk. Credit unions must monitor and manage these commitments carefully, ensuring they have adequate funding and liquidity to meet potential downdraws. Credit unions can maintain liquidity and avoid funding shortfalls by effectively monitoring and managing unfunded obligations. Finally, regular asset quality monitoring is essential for controlling asset composition and managing liquidity risk. Credit unions should assess the credit risk of their assets and identify potential weaknesses. If these weaknesses lead to increased delinquencies, expected cash flows may be impaired, potentially triggering contingency funding needs. By proactively monitoring asset quality, credit unions can anticipate funding shortfalls and preemptively manage liquidity gaps. Controlling asset composition and credit union balance sheets requires aligning credit policies with cash flow expectations, managing unfunded commitments, and monitoring asset quality. By effectively managing these aspects, credit unions can optimize their balance sheet, reduce risk, and achieve their financial objectives. The next area of concern is the structuring of liabilities. Liability structuring involves managing funding sources to support the institution's operations and growth while aligning with its strategic goals. I will discuss three fundamental aspects of liability structuring: stable funding, matched funding, and ensuring consistency with strategic objectives. Many consider stable funding the main component of liquidity risk management for credit unions. Credit unions aim to secure stable, long-term funding sources to support lending and investment activities. This stability reduces reliance on short-term, volatile funding sources, such as overnight borrowings, to support long-term assets. Stable funding sources include member shares, long-term borrowings, and retained earnings. Credit unions can maintain liquidity and financial stability over the long term by emphasizing these stable funding sources. Matched funding is the second aspect of liability structuring I will discuss. Matching the maturities of assets and liabilities is crucial for managing interest rate and liquidity risks. Credit unions typically use a mix of short-term and long-term liabilities to fund their assets. By aligning the maturities of these liabilities with the expected cash flows from assets, credit unions can reduce the risk of funding mismatches and interest rate fluctuations. This approach helps ensure the credit union meets its financial obligations while optimizing its balance sheet structure. Finally, when structuring liabilities and matched funding, credit unions must consider their strategic goals, such as growth targets, risk tolerance, and member service objectives. For example, if a credit union aims to expand its loan portfolio rapidly, it may need to secure additional funding sources to support this growth. Credit unions can effectively manage their balance sheet to achieve long-term success by aligning liability structure with strategic goals. In conclusion, structuring liabilities on a credit union balance sheet involves managing funding sources to ensure stability, align with strategic goals, and mitigate risks. Credit unions can optimize their balance sheet structure and enhance their financial performance by employing stable funding, matched funding, and consistency with strategic goals. The principles of governance and monitoring for liquidity risk are precisely the same as they are for anything else the board and management oversee. Today, I will focus on establishing clear roles and responsibilities, defining triggers to distinguish between normal and contingency funding needs, and ensuring timely and accurate reporting. First, as with all governance policies, it is a must to clearly state roles and responsibilities for managing liquidity risk. This includes identifying key personnel, monitoring liquidity metrics, assessing funding needs, and implementing contingency plans. The policy should clearly state the authority to make decisions and act within various roles, the triggers requiring higher levels of escalation, and bright lines between normal operating liquidity and contingency funding. By clearly defining roles and responsibilities, credit unions can ensure adequate oversight and accountability in liquidity risk management. The second area I will focus on are triggers to distinguish between everyday and contingency funding needs. Credit unions should establish triggers to differentiate between regular liquidity needs and those requiring contingency funding. This entails understanding the range of funding needs considered business as usual and closely monitoring short-term sources and uses of funds. These triggers may include expected daily cash in and outflows, specific liquidity ratios, such as the loan-to-deposit ratio, or qualitative factors such as changes in market conditions or member behavior. By identifying these triggers, credit unions can proactively manage liquidity risk and take appropriate actions to address funding needs. Third, effective monitoring is most useful for regular reporting on liquidity metrics, which is essential for effective liquidity risk management. Credit unions should report critical short and long-term liquidity indicators to senior management and the board of directors. Timely and accurate reporting enables credit unions to monitor liquidity risk, assess the effectiveness of liquidity management strategies, and make informed decisions to mitigate risks. Credit union governance and monitoring of liquidity risk management are crucial for maintaining financial stability. Credit unions can effectively manage liquidity risk and safeguard their financial health by establishing clear roles and responsibilities, defining triggers for funding needs, and ensuring timely and accurate reporting. Diversified liquidity sources are crucial for credit unions to ensure they can meet their funding needs under various circumstances. By accessing multiple funding options, credit unions can reduce reliance on any single source and enhance their ability to manage liquidity risk effectively. Several key diversified liquidity sources for credit unions include, first, member shares. Member shares are a primary and stable source of funding for credit unions. By offering various share accounts, such as savings, checking, and certificates of deposit, credit unions can attract and retain member funds, providing a reliable source for liquidity. Second, the investment portfolio. Credit unions can maintain an investment portfolio consisting of liquid and marketable securities, such as treasury and agency bonds. These investments can be readily sold or pledged as collateral to generate liquidity as needed. And third, the loan portfolio. We've already discussed the loan portfolio under the asset composition section. The loan portfolio generates cash flow through member payments, loan sales, or securitizations, and may serve as borrowing collateral. Fourth, borrowings from other financial institutions. Credit unions can borrow funds from other financial institutions, such as other credit unions, corporate credit unions, the Federal Home Loan Bank, the Federal Reserve's discount window, or the NCUA Central Liquidity Facility. Borrowings can provide additional liquidity during increased funding needs or when internal sources are insufficient. Diversified liquidity sources are essential for credit unions to effectively manage liquidity risk. Credit unions can enhance their liquidity risk management capabilities and maintain financial stability by accessing various funding options. The expectations for contingency funding are set in Part 741.12 of NCUA's regulations and are spelled out on the slide. So rather than read them, I will discuss the critical components. First, considering the potential need for contingency funding means a credit union funds regular operations. Credit union policy must address liquidity under regular operations and spell out or establish triggers for contingent funding needs and operations. For example, borrowings can serve as a safe and sound source of funds for normal operations and play an important role in contingency funding plans. Second, in addition to meeting normal liquidity requirements and contingent liquidity sources, the contingency funding plan must include 1. Policies to manage stressed environments, identify possible stress events, and identify likely liquidity responses to events. 2. Lines of responsibility within the institution to respond to liquidity events. 3. Manage processes that include clear implementation and escalation procedures for liquidity events. And 4. The frequency that the institution will test and update the contingency funding plan. The third component I want to address is the requirement for credit unions with 250 million or more total assets to have documented access to one or more federal liquidity sources. The Federal Reserve's discount window and the NCUA Central Liquidity Facility are the only two federal liquidity sources. Federal home loan banks, due to their mission and market-based criteria, are not considered federal liquidity backstops. So, despite not qualifying as a federal liquidity source, credit unions may include federal home loan banks in their regular liquidity operations and in parts of their contingency funding plans. So, thank you for your time, and I will now turn it back to Christelle.
Thank you so much, Dale, for all of that great information. Now, with that, I would like to turn it over to Policy Officer Elliot Weiss, who will guide us through the Q&A session. And it looks like we have a few coming in already. So, Elliot, I'll turn it over to you.
Thank you, Christelle. Again, my name is Elliot Weiss, and I'm a Policy Officer in the NCUA Office of Examination and Insurance. And we've got some questions lined up already. We've got another about 28 minutes left in this webinar. So if you can think of any other questions in this time frame, feel free to put them in the Q&A portion of WebEx. Okay, first question that we have is for Dale. Dale, as a credit union with over 250 million in assets, do I have to follow all parts of section 741.12 of the NCUA regulations and have a written liquidity policy, a contingency funding plan, and access to a contingent federal liquidity source?
Hey, Elliot, thank you for the question. And the answer is yes. And thank you for flipping back to slide 16 for this. So the requirements under 12 CFR 741.12 are cumulative. So credit unions with less than $50 million of total assets are required to have board-approved liquidity policies and list contingency liquidity sources. Now, credit unions with 50 million or more are then required to have a contingency funding plan. And then on top of that, when a credit union reaches 250 million or more of total assets, they then must add access to federal contingency funding sources. So the answer is yes, the requirements are cumulative. Thank you, Elliot.
Okay, thank you, Dale. I'll take the next question. Question is, will continuing professional education or CPE credits be offered for this webinar? And unfortunately, no. There will be no CPE credits offered for this webinar. I'll take the next question as well we have here. There's been several questions related to this one. Will the presentation slides be made available to the participants? And yes, those are available in WebEx. If you don't have access to them now, you may need to go back out and re-enter your information in the WebEx registration page in order to download those slides. Okay, next question is for Senior Capital Market Specialist Jonathan Farrell. Jonathan, how frequently do you, as NCUA, expect institutions to update cash flow forecasts?
Jonathan. The frequency of your cash flow forecast updates is going to be determined by your liquidity position. We want to give institutions credit when they have a very strong liquidity position. If you have a regular rating of ones and you have ample on balance sheet liquidity, the frequency of how frequent you need to update your assumptions is going to be less than if you're an institution where you're trying to run it kind of a thinner liquidity manner, where you're trying to use maybe alternative funding sources or things that are just maybe more volatile funding types. In those cases, you're going to want to update it more frequently. I would say in no scenario you're going to probably see less than quarterly updates, but certainly for those where you're having a pretty complex liquidity profile, you might see it as frequently as weekly, depending on the types of liquidity needs that you have. So it really depends on your institution and the risk profile that you're presented with. Thank you.
Okay, thank you, Jonathan. The next question is for Dale. Dale, In our cash flow forecasting, is it sufficient to estimate overall loan growth and share growth over a 12-month period? Or do we need to break it down by originations, contractual payments, maturities, and prepayments, early withdrawals?
Thank you, Elliot. And the answer is always it depends, but in general, what is best is that both inflows and outflows are broken down and not aggregated. It is best to look at what's happening on the balance sheet by different line items in your projections in kind of a gross capacity, not a net capacity. So in other words, aggregation is insufficient really for liquidity planning purposes. You really need to look at the intra-period cash flows to make sure that they're not obfuscated. Thank you, Elliot.
Okay. All right. Thank you, Dale. The next question is for Jonathan. Jonathan, can you review what sources are not federal liquidity sources? And where can we find the list? And it's a two-part question. And what was the second federal funding source? Was it FRB and?
Yeah, so it looks like we have some confusion about what the contingent federal sources are. The only two are the Federal Reserve Board and the Contingent Liquidity Facility, the CLF and the Fed. So if you have one of those two, that meets the requirement, but other sources such as corporates, correspondent banks, FHLBs, they do not meet the requirement for being a contingent federal source. Thank you.
All right, thank you, Jonathan. We do have several other questions in the Q&A, and we're looking through those right now and trying to sort through those. So if Presenter Dale and Jonathan can take any, I'm seeing some come through now. Okay, we've got another one. Jonathan, with member behavior changing in this rate environment with deposits, what types of stress tests do you recommend to test liquidity?
Thank you. I think, right now, especially, we're seeing a lot of variation across what people's assumptions were requiring related to their decay assumptions for their deposits, as well as just general loan prepayment. So, really you want to stress a lot of the same things that you're going to be looking for in your interest rate risk assumption testing. Look at your cash flows. As Dale mentioned, you're going to want to look at those unfunded liabilities. If you have a large glut of those or those are growing, that's something to look at, particularly if you anticipate a market downturn. But when we're looking at your stress scenarios, a lot of that's going to be developed in your stress cash flow analysis stresses that you kind of develop. There's a really, really good primer that's discussed in the 2010 Interagency Policy Statement on Funding and Liquidity Risk Management that really walks through the types of stresses that you should approach for your institution. You want something that's going to be institution specific and both low probability high impact and high probability low impact. But essentially, when you're developing those, it's not just about, what's the regulator want to see, but more ultimately, it's about what's the risk to your institution. What are the areas where, if you did have variance in that would be, more material for your overall liquidity position. And then you want to stress those to see how you would react to those in a realistic way. So for these and for questions about the assumption sets and what types of stresses you should be looking for, I think we can list some examples, but I think the 2010 Interagency Policy Statement on Funding and Liquidity Risk Management is going to be the best document for assessing those types of risks for your institution and developing those kind of stress tests. Thank you.
Thank you, Jonathan. Dale, the next one is for you. Should the NCUA January 2024 advisory have also included references to the Basel framework? Why doesn't the NCUA website related to liquidity resources mention items such as liquidity coverage ratio when NCUA examiners are mentioning such ratios? So basically it's a two-part question. One, should we also include the Basel framework? And secondly, why doesn't the NCUA website related to liquidity resources mention like the liquidity coverage ratio when the NCUA examiners are mentioning those during exams or contacts?
Hey, thank you, Elliot. And for the first part of the question, the NCUA has not adopted the Basel III liquidity prescription. So that's the reason why the Basel III liquidity framework is not mentioned or referenced in the January advisory on liquidity risk management. Now, for the second part of the question, specific ratios, regardless of what they are listed in various different ways within NCUA guidance. So we have the NCUA's Examiner's Guide, and we also have the Financial Performance Report for credit unions. And in there are different ratios that are used for indicating various levels of liquidity risk. And examiners do use those ratios in their examination process. So I hope that suitably addresses the questions. Thank you, Elliot.
You're welcome. And I believe there's also ways that they can get the definitions to those ratios too, right, Dale? So they can know what goes into those. That's in the FPR.
There is. There are instructions for data dictionary for those ratios as well.
Yep. Thank you. I appreciate that, Dale. And keep your mic on because the next one is going to you. Dale, could you please share the website addresses to the Federal Reserve discount window and the NCUA SCLF, the Central Liquidity Facility?
So I can't type those in right now, but they are available on the NCUA.gov's landing page for liquidity risk.
Okay.
Thank you, Elliot.
Thank you. You're welcome. Thank you, Dale. Next one's for Jonathan. Although I'm not a credit union over 50 million in assets at this time, I would like to have a contingency funding plan. Do you have policies for this? Also, do you have a cash flow analysis that you could share with us?
This is Jonathan. While we don't have a cash flow analysis we could share with you or a template, I do want to plug again the 2010 Interagency Policy Statement on Funding and Liquidity Risk Management. It does walk through the individual components of a CFP, what considerations you should take when you're developing those, and what are the essential pieces. All the regulatory agencies, be it FDIC, OCC, ourselves, Fed, all have a pretty aligned perspective on what CFPs entail and have been kind of slowly and iteratively updating that. Earlier this year, we actually had an update to the 2010 Interagency Policy Statement. So that's going to be your best source for developing one of those. And it really is one of the best written, most clear advisories that we have out there. It's very clear. If you walk through it, it should help you kind of consider what you should be thinking about as well as the structure of how you should be developing that. So thank you.
All right, Jonathan, thank you for that. And the next one is coming right back to you. Is a credit union with total assets of over 250 million required to have access to the Central Liquidity Facility in addition to the Federal Reserve?
Thank you. No, you are not required to have both. You need to have a federal contingency source, and that can be either the CLF or the Fed. However, if you do want to have both, we are never going to be frustrated by additional sources of liquidity. But to meet the requirement, you need to have one or the other or both. That's the answer. Thank you.
All right. Thank you, Jonathan. Next one is back to Dale. Dale, what's a major liquidity measure that the NCUA prefers? How can we define a standard measure of liquidity?
Well, this question is complex, and I'll try to simply answer it. First, the NCUA does not have a single preferred measure for liquidity risk. or for liquidity in general. The right answer is the metrics that are relevant depend on the credit union. What is the credit union's lines of business? How is liquidity risk managed? And what are the relevant daily, weekly, monthly, and longer term cash flow sources and uses that the credit union has to manage? So to define a standard measure of liquidity is really a credit union dependent type of measurement. So again, the NCUA does not have a single preferred measure of liquidity. We look at it holistically and try to balance out the credit union's needs for sources and uses of funds. Thank you, Elliot.
You're welcome. Thank you, Dale. The next one is for Jonathan. Jonathan, how many months out should we project cash flow? Are 6 months enough, or do we need to go out till 12 months?
I think a 12-month rolling is probably going to be your most effective. The challenge with periods shorter than the 12 months is that you may not be able to capture, some significant seasonal shifts in your overall deposit base. Obviously a lot of institutions are going to see big changes around the end of the year, around tax time. And if you're not anticipating, what some of those flows are going to look like because you're only out a few months, it may not give you the sufficient runway to be able to adjust your liquidity position to account for what some of those shifts are. So we look for something closer to 12 months. Many institutions run it all the way out for a few years. That's not a requirement, but sufficiently that you can capture not just your monthlies, but also your seasonal flows. Thank you.
All right, thank you, Jonathan. Dale, the next one's for you. What are the various Federal Reserve Bank funding options? We have collateral at the FRB, Federal Reserve Bank, for emergency funding, and we've utilized some of the lower rate BTFP, Bank Transfer Fund, borrowings. But however, with the BTFP no longer offering issuances, are there any other FRB funding options that have longer borrowing terms similar to the Federal Home Loan Bank?
Well, that's a good question. And the Federal Reserve discount window programs are basically fairly simple. There is a primary credit, secondary credit, and seasonal credit. And your relationship with your local reserve bank helps you guide through those different options. Now, placing collateral or pre-placing or pre-positioning collateral with the Federal Reserve Bank is a very sound practice to do, and it's encouraged. Now, when you are pre-positioning collateral at a Federal Reserve Bank, it's also important to understand and remember what program you have that collateral pre-positioned in. Now, there are instances where financial institutions need to pre-position collateral for the payment systems operations that the Reserve Bank offers, and those are different than the collateral that's posted for the discount window. So it's important to understand that distinction. Now that the Bank Term Funding Program is closed to new advances, the discount window offerings are limited to their additional ones, or to their original ones, and that is again the primary credit, secondary credit, and seasonal programs.
Thank you, Dale. Thank you. You're welcome. These are some great questions. Next one goes back to Jonathan. Jonathan, if expected conditions forecast like 12 to 24 month timeline is completed, 12 to 24 month timeline is completed quarterly, how often does stress testing need to be completed? Like for a $1 to $5 billion credit union?
Typically, if you're going to be conducting your updates to your forecasts, we kind of expect to see the stress testing done concurrently. So if you're doing that quarterly updates, we would expect stress testing to be updated quarterly. But to be clear on that, that doesn't mean that you need to run every single stress test that you have. The larger your institution becomes, the more work is going to go into that process. So if you want to run some of those throughout the course of the year, run a certain type first quarter, different type second quarter, different type third quarter, as long as you're hitting all of those and you're not ignoring any particular stresses that you anticipate being in the, high probability, low impact space, it's probably sufficient. But again, that's going to depend on your risk profile and how tightly you like to manage your liquidity. Thank you.
Thank you, Jonathan. You can keep your mic off of mute because the next one's coming back to you. Due to the rising rate environment, most credit unions with available for sale securities are in significant unrealized loss positions, which credit unions are adopting a hold strategy to recovery. How do you address this as part of your liquidity reviews, as generally credit unions don't want to sell investments as part of their strategy?
Absolutely. We are seeing, obviously, a lot of this out in the market. Typically, your securities portfolio, your investment portfolio is considered a source of liquidity, but when it's significantly underwater, you have to take into account, whether or not there's a willingness to sell and obviously the capital impact that's going to have. So examiners in the field are looking at those numbers, seeing how far that is underwater, determining the impact on that capital position, and then assessing whether or not they think that is a source of liquidity in the current market. So you're probably having a discount relative to what you would normally get for your securities portfolio if you're significantly underwater for the credit you're getting towards liquidity. Now, obviously, if you were in the BTFP program or something along those lines where you're getting par for that, then you get kind of a commensurate boost in the off-balance sheet sources of borrowings that you could otherwise draw to. That is another source of liquidity strength. But, it takes it kind of out of that on-balance sheet liquidity and moves it over to that off-balance sheet liquidity. But ultimately, dividing those up, if you have an assessment of these are the types of securities out of this portfolio I would sell, these are the types I wouldn't, and you've made an analysis as to why you would support that, and you provide that to your examiner, they're going to take into account the types of analyses you've already done. So the more pre-work you've done where you've made those types of assessments, the more that we can help take that into account. But obviously, if there's a situation where we just don't see how you'd be able to do that without taking you down in a, outside of your capital policy or even into a PCA category, we may have to discount those for your overall liquidity review. Thank you.
All right, thank you, Jonathan. The next question is for Dale or Nagi Khalid, who is our credit market director on the webinar. Is it possible to review again how a credit union's loan portfolio affects liquidity and the steps needed to balance each?
Hey, Elliot, I'll start with answering this and then I'll hand it off to Nagi. So the credit union's loan portfolio provides cash flows for the credit union, cash inflows for the credit union. And it's a sound practice to understand those cash inflows when thinking about what the credit union's cash outflows may be. And then on top of that, with the credit portfolio, it's important to understand the unfunded commitments, such as credit cards, and the behavior of those, so that as those cash outflows might be called by members, that the credit union understands what liquidity options are at hand and how they should act. And then the final thing that I mentioned earlier under controlling asset composition is asset quality. So when loans move through various stages of delinquency, cash flows are impacted by that. And understanding asset quality and its implication on when the credit union receives coupon payments from members on these loans, that it's important to understand that as they're thinking about cash inflows. So with that, I'll let Nagi respond.
Thanks, Dale. And Yeah, just to piggyback off of what Dale said, so as the credit union, so the composition of a credit union's loan portfolio, it plays a pivotal role in determining its overall liquidity position. And as a credit union is extending loans, it has to keep in mind that it must carefully maintain sufficient liquidity to meet its outflows, like Dale mentioned, whether it's through deposit withdrawals, other loans, or unexpected expenses. Because the loan portfolio itself can affect liquidity in several ways, whether it's through loan maturity mismatch, like Dale mentioned, the loan quality of the portfolio, and even interest rate risk. If the loans are fixed to interest rate and market rates rise, credit may struggle to attract deposits competitively, which affects its liquidity. So I believe the second part of the question is how do you balance that? And some things to keep in mind to be on the lookout for and carefully monitor is the loan to deposit ratio, to make sure that it remains within manageable levels. And as Dale mentioned, as well as diversifying the loan portfolios and spreading it across different sectors and risk levels to mitigate any sort of impact of defaults. And of course, maintaining adequate reserves and access to funding sources, which Dale discussed in depth during the webinar. And also one thing that comes to mind is regularly reviewing and updating the credit union's asset and liability mix to make sure that liquidity is maintained while maximizing their returns. Thank you.
All right, thank you, Nagi and Dale. We are at 2:57. We have time for one more, maybe two more. We will see. Dale, if a credit union pledged collateral to use the bank term funding program, if they leave it as pledged, could it be used again if they ever need the discount window? Right. So I should have first, thank you, Elliot. And I should have mentioned this before when I was asking or answering a Federal Reserve related question. It is really Federal Reserve Bank policy that guides these answers. So anything I say is just kind of it is not setting policy for the Federal Reserve System. Now, in general, when collateral is pledged for a facility such as the bank term funding program, it falls under a bucket that is used for the various types of advances or facilities under that program. So, for example, if you have funds pledged for the bank term funding program and they remain pledged at the Federal Reserve in their discount window operations, they would then again be available to be borrowed upon later. But the specific logistics and requirements of that would be dependent upon the Reserve Bank. Okay. Thanks, Dale. All right, we'll do one more question, real quick one for Jonathan. Jonathan, what is the NCUA's position on building a specific hold to maturity portfolio with a specific cash flow focus versus classifying all investments as available for sale?
This is a good question. I'm glad it was asked. The NCUA is agnostic as to the accounting treatment you give to your securities. If you obviously meeting the requirements for HTM, you have the ability and intent to hold till maturity versus having things available. It's purely an accounting difference. Ultimately, when people are reviewing your institution, the distinction between the two shouldn't make that big of a difference because it's not a financial difference, it's an accounting difference. If you want to develop an HTM specific portfolio and that meets with the objectives of your institution, then feel free at it. We're not going to look at it any more negatively or positively than we would an AFS portfolio, outside of you might have potentially a few more questions with an AFS portfolio because it is supposed to be something that is relatively manageable from a daily or weekly or monthly perspective, as opposed to HTM that's supposed to stay pretty quiet. So, make your strategy. As long as it meets the regulatory requirements and accounting requirements, then we'll look at it in context of the broader picture. And that's all. Thank you.
All right. Thank you, Jonathan. And that concludes the Q&A portion of our webinar. I will turn the floor back over to Christelle to wrap things up. Christelle?
Thanks so much, Elliot. So with those questions, we've come to the end of our webcast. Thanks again for joining us today. We hope you found this information helpful. Note we will send out an email providing the link when today's webinar recording is available for on-demand viewing. And last, on behalf of myself and all of our presenters, we want to thank you for attending our webinar. We hope you found this information helpful as you navigate the ever-changing financial landscape. Thank you.